The oil crisis just escalated, and the economy is next.
We need to talk about a geopolitical crisis that's unfolding right now. And look, it might have started with military strikes halfway across the globe, but it could end up hitting you right where it hurts the most, your wallet. So today, we're going to connect the dots from that conflict zone straight to the global economy.
And the stakes? They really could not be higher. I mean, this single quote says it all. We are talking about a shock to the system big enough to trigger a worldwide recession. So how on earth did we get to such a dangerous point?
So, to really get what's at stake here, we've got to rewind the tape a little bit. First up, a global flashpoint, where we'll look at exactly how we got here. Okay, so here's the quick backstory. For the last year, the US and Iran were trying to hash things out over Iran's nuclear program. But then, those talks just fell apart. And when intelligence came out that Iran was just weeks away from having a nuke, the US launched a strike they called Operation Epic Fury. But Iran didn't back down. Not at all. Instead, it retaliated and, this is the crucial part, it threatened to shut down one of the world's most vital economic lifelines.
If this oil crisis gets worse, what breaks first? Fuel prices, supply chains, or jobs?
And that threat to shipping lanes brings us right to the heart of this whole crisis. This next part is all about the world's oil choke point, the Strait of Hormuz. It's this tiny stretch of water that quite literally holds the global economy in its grip.
So this is the Strait of Hormuz. Geographically, it is the only sea passage from the Persian Gulf to the open ocean. It's surrounded by massive oil producers, making this waterway an absolutely critical choke point. And as you can probably see, Iran's position right there gives it some serious leverage over all that traffic.
And the numbers, they're just staggering. Every single day, 1/5, a full 20% of the entire world's oil supply sails through this one narrow passage. Think about that for a second. That's the oil that powers our cars, our industries, pretty much our entire lives. And you know what? It's not just oil. A full third of the world's liquefied natural gas also passes through here. So if you shut down the strait, you're not just turning off one tap, you're turning off two of the biggest energy taps on the planet at the same time.
Now, what's really interesting here is where all that oil is going. And yeah, while 84% of it is headed for Asian markets, the real answer to who benefits from this strait being open is, well, it's everybody. See, keeping it open frees up supply from other regions, and that helps keep prices stable for all of us. Okay, so a blockade there doesn't just stay there. Let's trace that economic ripple effect from a conflict zone all the way to your bank account.
Okay, so here's the domino effect. First, the strait gets blocked. Boom. Step one. Right away, the global oil supply tanks. That causes the cost of shipping and producing pretty much everything to skyrocket. And the final domino to fall? That's when widespread inflation hits, and everything, from gas to groceries, gets a whole lot more expensive.
And the real-world impact? It's pretty severe. JP Morgan thinks oil could surge to $130 a barrel. For a typical family with 2 cars, even a small $10 jump in oil prices could mean an extra $200 to $500 a year out of your pocket. And on top of that, fertilizers go through the strait too, which means food prices would start climbing, hitting folks on lower and middle incomes the hardest. So, we've seen the damage this could do. The big question now is, what happens next? Let's explore the 3 potential paths for the future and how this whole crisis could unfold.
All right, you've basically got 3 ways this can play out. First up, containment. This is the best case scenario, where things calm down in about a week. Oil prices might see a small bump, but the markets would recover pretty quickly. Then you have escalation. This is where the conflict drags on for months, leading to a huge price hike and the risk of something called stagflation. That's that nasty mix of high prices and a slowing economy. And then there's the worst-case scenario, a full shutdown. This is the catastrophe, risking a severe global recession.
Okay, so all this brings us to the single most important question, right? What does all this chaos on the world stage actually mean for your money?
All right, this is where things get a little weird, a little counterintuitive. In the short term, all this global uncertainty can cause what's called a flight to safety, where investors dump other currencies and pile into the US dollar. That demand can actually make the dollar stronger for a bit, and maybe even push mortgage rates down. But here's the catch. Long term, if the conflict keeps inflation high, the Fed can't cut interest rates. That could mean higher rates for longer and a weaker dollar overall.
Now let's talk about the stock market for a minute. It's totally natural to want to hit the panic button when you see headlines like this. But history gives us some really fascinating context here. Turns out, big market drops, while they feel awful, are actually more severe during midterm election years. As you can see, since 1950, the average pullback in a midterm year has been over 17%.
But if you only focus on the drop, you're missing the most important part of the story.
And here it is. In the 12 months after a midterm year low, the average stock market return has been almost 32%. And get this is the crazy part. In all of modern history, that return has never been negative. In times of total chaos, data like this can give you some incredible clarity.
Which kind of leaves us with this one big question, doesn't it? When the headlines are screaming crisis and every instinct in your body is telling you to run for the hills, the data tells a very different story. So you have to ask yourself, when the markets panic, is history truly our best guide?